Well, welcome back to Financial Accounting and Analysis. The focus now is on part segment C of Chapter 7. And we're going to start out by describing the accounting and reporting for intangible assets. So these are assets that are of value. They help us produce income in future years, but they have no intrinsic, there's nothing tangible about them. You can't physically touch them. They're not a building, or they're not oil in the ground. These are things that we own that they have a value, but they lack physical substance. Hey, there's a direct quote there: revenue producing assets that lack physical substance. So examples of this: intellectual property rights, such as copyright that you might have in a book, patent that might be in a computer, or goodwill. Goodwill in this context only comes as a result of merger and acquisition activity. Cannot create under US GAAP, you cannot create your own goodwill. Some other countries like France and so forth, they do have the opportunity to recognize their own goodwill, but we don't have that under US GAAP. There are scenarios where certain marketing and advertising costs could be capitalized, and research and development costs generally in the US, no, but under international accounting standards, development costs, yes. This particular section, by the way, will be very relevant for you when you do problem 727. So examples: patents and copyrights. So these are amortized. So we amortize these generally under the straight line method. Go back there, went quick there. So patents and just about all these intangible assets are going to be amortized on a straight line basis, but not all intangible assets are going to be amortized. They're all subject to impairment, but goodwill, for instance, although it's an intangible asset, is not amortized. But patents and copyrights would be, and we would use the straight line method, and we would amortize those over their useful lives. Goodwill. In the US GAAP, you cannot create your own goodwill, at least not on the financial statements. So goodwill comes as a result of one company acquiring another company. And whenever they pay more for that company than the fair market value of that company's net assets, they recognize goodwill. So if you had a company, you acquired it, and they had $100,000, make it a small company, $100,000 was the fair market value of their assets. They had $20,000 worth of liabilities that you assumed. So you say, okay, that company should be worth $80,000. But if you paid $130,000 for it, then you'd have $50,000 worth of goodwill. So again, goodwill, very specific, only comes as a result under US GAAP or merger and acquisition activity. And it's the excess that you pay for a company over and above the fair market value of its net assets. So you have to figure out the fair market value of its assets, subtract any liabilities that you assume. That's the market value of that company. And if you pay more for that company than the fair market value of its net assets, then you recognize goodwill. You could have negative goodwill, very rare. I've never seen it, but it must be out there somewhere. So when you acquire a company for less than its reported book value, then you've got something called negative goodwill, and that would be recognized on the income statement in the year of the purchase. Okay, so goodwill, unlike the other intangible assets, is not subject to amortization, but it has to be reviewed annually for impairment. So impairment, like we had with the impairment of the property, plant, and equipment that we had in the previous section. So we're going to reduce the goodwill account to recognize an impairment loss on the income statement. So how do we do this? Okay, so first we identify the amount of goodwill associated with the prior corporate acquisition. And then we've got to go ahead and compare the book value that we have on our books versus the current market value. If that amount is greater than the current market value of the goodwill, then we have to recognize an impairment. All right? And any goodwill is written down, and we would recognize a loss. And again, those of you who are doing COVID-19 related SMACs, don't be surprised if you've got companies actually writing down their goodwill. So goodwill impairments, this is an interesting statement, are infrequent. But again, I think when this whole COVID thing is done, you're likely to see quite a few companies write off some of their goodwill. Okay, some other costs and capitalization issues relative to intangible assets. We have research and development costs. So under US GAAP, R&D, all those expenses that the pharmaceutical companies, the evil pharmaceutical companies, put into researching new drugs, they have to expense those in the year incurred. But under IFRS, the research costs are expensed, but certain development costs could initially be recorded as an asset when the product becomes viable and it's evident there is a market demand. So development costs, the costs of actually getting the product ready for market and so forth, those could actually be capitalized. So you get a difference between US GAAP and international GAAP. Now here's an interesting problem. So here I am defending the the drug companies. So if a company has to write off all of its R&D costs, and it may take years to research a new drug, they're going to show very high profit margins when the product is ultimately produced and sold, because all the costs of developing, researching for that product and developing that product had been expensed in the previous period. So it can become difficult, particularly for pharmaceuticals, to assess the true underlying profitability of the product. So next time you hear someone criticize the obscene profits of the pharmaceutical companies, take a look at what those companies had been paying and had been recognizing at expense for their research and development costs. So we do also have other issues. We have marketing and advertising, which in most cases is going to be expensed. So these should be advertising and marketing, general marketing and advertising costs should be expensed when incurred, both on the US GAAP and international GAAP. Because again, you cannot match the actual advertising cost to the period of time that they would be benefit. There are certain cases where marketing costs can be capitalized. So for instance, if you're producing a catalog and the catalog it's going to have 2 years and you got all the costs put into developing that catalog and distributing that catalog, then you could make a case in the case of catalogs for actually capitalizing the advertising costs. So keep that in mind when you do problem 727. Okay, natural resources. So describe natural resources and how they're reported on the balance sheet. So natural resources, examples of this: timber, oil and gas, iron, silver, gold, uranium. Those are all examples of natural resources. So when we buy these from other companies, we report these on the balance sheet at their acquisition cost. So whatever you paid for them would be the amount that they would be carried on the books. However, when you internally develop your own natural resources, you've got two valuation approaches that are available. And these are called the full cost method. So all costs associated, case in a drilling an oil well, all costs associated with exploration and development are capitalized on the balance sheet, even if for say the cost of drilling an oil well, if it proves to be that there's no oil under the ground for that well, you still would capitalize all the costs. Successful assets, you only capitalize those costs associated with the successful efforts, and the cost of any unsuccessful activity is immediately expensed against net income. So under on the full cost, you capitalized everything. Under successful efforts, you only capitalize those costs associated with successful oil wells. All right, now, in terms of financial reporting, only the smaller companies tend to use the full cost method. And I think you can speculate why, because on the full cost method, you're going to capitalize all the costs, even for the unsuccessful wells. So anyone who used full cost is going to show higher profits. So let's contrast the two. And remember this when you get into exercise 718. Okay, so here's the cost. Now, this is just the cost of drilling the wells. So if there were other costs associated with this, such as buying the land and clearing the land and so forth, those would both be capitalized. Here, we're just focusing on the drilling costs. So under full cost, you drilled 4 wells, and each well cost you $1 million to drill. So you would capitalize $4 million under full cost. Under successful efforts, you would only capitalize the costs, the drilling costs for those wells that were successful. So the other $1 million for the unsuccessful well would actually be expensed immediately in the year that you incurred those costs. So they'll give you very different answers. So full cost versus successful effort. Now, again, regardless of which of these methods that you use, you also have, other costs that would be related to the natural resources, other than the cost of just these drilling costs. Okay, so let's compare U.S. accounting for long-lived assets. Let's compare U.S. GAAP to international financial reporting standards. So there are differences, okay, and there's two big differences. So under international reporting standards, yes, they write down assets like we do because of impairments, but they also write them up. Remember this when you answer that first question in the homework. They also can write them up. They recognize the increase in the market value. Okay, so that's a big difference between the two. Tests for impairment under GAAP, we're going to compare the undiscounted cash flows to the property, plant, and equipment against its book value. That's how we're going to test for impairment. So under international GAAP, you're going to assess the recoverable value of the PPE against book value. So there's a slight difference there in terms of how you calculate the impairment. So be mindful of how we do it for the US and be aware of the fact that under international, it's a different calculation. Another thing, IFRS permits interest costs during construction to either be capitalized or expensed. And in the US, we have no choice. We have to, if we have costs, interest costs incurred on self-constructed assets like retooling the assembly line, then those interest costs must be capitalized. On an international GAAP, they have the option to either capitalize or expense. There are some critical differences in international GAAP, US GAAP with regard to intangibles. So under US GAAP, development costs are expensed immediately as part of research and development. And under international costs, some development costs are capitalized if we've got, if it's clear that these things are going to have future economic benefit, they can be capitalized. So US GAAP, basically, we don't recognize, we don't capitalize development costs. Under international GAAP, we do. Again, big difference between the two. Last one here is just due diligence. So those of you who are doing SMACs where you're evaluating two companies, if you compare two companies, this little due diligence that you do with the disclosures, it's significant when you take a look at the company's capital investments. So basically what you're doing is you're reviewing how the company accounts for its long-term investments, and you've got kind of a critical eye here. So the amount of the company's investment, if you look in the investing activities on the statement of cash flow, you can see how much a company actually invested in property, plant, equipment, and its other long-lived assets. Okay, so you've got maintenance capital expenditures and you've got incremental capital betterment expenditures. So you have to look at both of these things here. So those would be the two types of costs of investment. We talked about these earlier. So one of the things you might want to take a look at is the number of years before a major capital financing will be required. So this is a measure in terms of, if the company is holding off on investments, what is the impact on that? So you can actually calculate the number of years if they want to maintain their current capacity, the number of years that major refinancing to acquire new assets is going to take. So you take the number 100 as in 100%. You take accumulated depreciation, which you can get off the balance sheet, divided by the gross property, plant, and equipment, and multiply that by the average life expectancy, and that'll tell you the estimated number of years that the company has before it has to make a major capital expenditure. So this is helpful in terms of, particularly when comparing two companies in the same industry. Questions you got to ask yourself when analyzing a company's capital investment: what is their depreciation policy? Okay, and are they using a policy that's similar to the industry? Are they using something else? And what is their rationale for doing something different than the industry? If they've changed its depreciation or amortization policy, this is something you might want to be skeptical of. Okay, did they? How do they relate to the industry norm? Anytime that you see the company changing its depreciation or amortization policies, that generally is a red flag for financial analysts and investors. And then do they have any unreported capital investments in intangible assets, such as patents, copyrights, and goodwill? So do they have things that they own that have a value that don't show up on the balance sheet? Should be aware of those as well. And if they're capitalizing expenditures, that should be calculated as an operating expense. Should you actually restate the financial statements? Again, we saw the classic case of this with the WorldCom, where they were actually capitalizing stuff that should have been expensed. And is the company taking regular capital investment write-downs or restructuring costs? So if they keep taking restructural costs, then what's going to happen is they're not going to be recognizing depreciation as a result of writing down the assets. So if the company is constantly doing that, and they're going to be showing that on their financial statements as kind of a special item, calling attention to the write-off and understating the depreciation expense, that's something that you want to be skeptical about. And if the company is capitalizing significant amount of interest costs, are they actually associated with the construction of self-constructed assets? Okay. And is the and if they are, then you when you were comparing two companies, you might have to restate their financial statements in terms of showing the actual for accounting for the interest. Okay, so that ends chapter 7. So I hope you enjoy the homework in chapter 7. I hope you found these briefings useful. And after I get done giving you individual feedback on the homework, and I will record a little mini lecture where I'll summarize kind of all the lessons learned, because as you've seen from the midterm, things that show up in these lectures and show up in the reading do reappear in exams, and they do appear in real life. Okay. So with that, I'll wish you adieu. Have a great day, and we'll see you again for the review of the homework. Be well, everybody.